everybody, to today's Tag Team Investment Club meeting. My name is Delzino Wilson Debriano. I'm the president of Tag Team Marketing, and I have the great pleasure of introducing you today to a financial, incredible, superstar, investing, powerhouse, mega man, Superman guy. How you like that?
Hey, that'll work.
All right. We have a brother right here who is absolutely genius, and it is my pleasure to say that I've had an opportunity to know him. He was a member of Tag Team many, many years ago. We're talking 1995, and here we come back. We're in 2009 now, and we have an opportunity to meet again where this brother's going to share with you principles, knowledge, information that has made him a success in life. All right? I'm talking about none other than Warren Thomas. And the information that he has, as you will see in these next few minutes, will not only impress you, but it will empower you with skills and techniques that you can use to take your financial future to an entirely new level. And so, brothers and sisters, it's without any further ado that I want to introduce to you, for the first time in front of Tag Team Marketing's audience, the Tag Team Investment Club, Brother Warren Thomas. All right. Brother Warren.
Thank you.
Thank you so much.
I appreciate it.
All right.
Can we give Delzino a big old hand? All right. All right. First of all, I'd like to thank each of you for attending in cyberspace and also in this glorious hall. Again, I really appreciate Debbie and Delzino for inviting me to come to speak to you guys as club members. And hopefully the information that I'm going to share with you tonight will, one, be uplifting, two, be entertaining, because I don't want to make you bored. But I really have to get a lot of important information out to you guys because right now, a lot of us are losing money in the market. A lot of us are losing money in investing. And I really want to stop the hemorrhaging, all right? I want to kind of turn it around, take you into triage, and take you out of triage all healed up and ready to go and tackle the world again. Is that a good thing?
Yes.
All right, so let's get started. Again, my name is Warren Thomas. I've been an investor for going on 20 years now. Real estate, stock market, currencies, bonds, options, you name it, and I can make money from it, I'll invest in it and so forth. So that's how we approach things. And my partner, my backbone, the woman that keeps me grounded, is my wife, Lorna Thomas. She's here with the audience. Please give her a hand also. And she's going to keep me on track because sometimes I will get off track and into other areas that still very informative, but I want to stick to the topic of hand. And so it's very important that we get forward because there's a lot to cover and so forth. Now, usually when I do a seminar, I try not to date myself or date the time because I like to make sure that whatever I'm offering can be utilized today or next year or whatever time in the future it can be utilized. But something happened interesting today that I got to date myself a little. Today being the 2nd, right? Today being the 2nd of March. Today we had a drop in the market of 299 points. Did everybody hear about that today? 299 points. That's a lot of folks losing money. And if you have a pension plan or a 401k, I put it like this. If you had a 401k last year, it's probably a 201k now. And that, for us, it's something to think about seriously because most of us have been taught the way we invest is to buy and hold. Your financial planner, your stock market advisor, your brokerage, stockbroker, everybody telling you, buy and hold. The way you're going to make money over the next 20 or 30 years is what? buy and hold. But if you bought and you're holding, you're losing right now. And that's where we need to move, folks, because the world is changing. And the strategies that we used 5, 10, 15 years ago may not work in the marketplace that we're in right now. I remember a good friend of mine who's a stock market investor. He told me that if you had invested after the 29 crash, that your portfolio right now would be in excess of literally hundreds of millions of dollars, all right, with just a $10,000 investment. Now, that's one of the things that most of the financial planners tell you, that the market will always recover. But the thing that they never tell people is that it depends on what time you get in the market. And two, it also depends on what stock you invest in. So if you invested in the wrong stock in 29 after the crash, guess what? You would not be up hundreds of millions of dollars. Also, if you invested, let's say, a year or two after 33, again, you may not be up in the market. So yes, if you were in the right place at the right time with the right stocks, you could have made money after 29's crash, the crash of 29. But it was not a guarantee that you would have. And part of what I try to encourage folks to understand, let them understand, is that though market experts, quote unquote, tell you market timing is not good, nobody's going to ever time the market, you can get a good understanding about the market when you understand cycles. Okay? You see, it doesn't matter if you're in stocks, real estate, bonds, there's always a cycle. And just as we know that after winter there's spring, after spring there's summer, there's a cycle. And as human beings, we're cyclical by nature. We do things on a cyclical level. So if we extrapolate that to all our endeavors, then the very things that we're involved in will also be what? Cyclical in nature. So if we look back at 29 and study the cycles, we realize that there were a series of great booms and periods of what? Crashes. There were minor crashes. We had the crash of 87. We had the crash of 91, 92. And we had something in 97, 98 called the aging contagion. Then we also had the 2000 crash, and a lot of us experienced that. I lost a lot of money during that period of time because I was just learning the business. And at least on the stock market side. I was already investing in real estate, but I was just learning the stock market side. And I'm going to talk about that as we go forward. So we understand that there's cycles. So let's go back. Kind of imagine with me 29, 25, 1920. And you see, it's very important that you guys understand this as an investment club. Because I'm going to teach you something that most investment clubs don't learn. You can join the NAIC, and they'll tell you about reading fundamentals and doing this with charts. And, you know, if this stock sells, if this sneaker company sells 100 million pairs of sneakers, they're going to make a lot of money. It doesn't mean their stock price is going to go up. Make that clear. It does not mean their stock price will go up. But let's go back to 29. Because I want to show you guys something. If you go on the internet right now and look up the crash of 1920 and 21, what's interesting about that period of time? Well, if you look back at that period, you'd realize that there were a series of bank crashes. Kind of sounds familiar? Woo! There were a series of bank crashes starting in New York. And, oh, wait up. Let's hold. Where did most of these money center banks are based? They're based where? In New York. Well, let's move forward. Well, a series of banks were basically becoming insolvent during that period of time. And what had happened, heading in from 1920, there was a period in the market called the Roaring '20s. If any guy's a historian, you remember, Miss Sadie's class, history class, she was talking about the Roaring '20s. Half of us was probably sleeping at that time. But when you go back to that class, you remember she talked about the Roaring '20s, and the girls used to be hoppers, and they used to wear the fan skirts and so forth, and the guys with the zoot suits and things of that nature. But at that time, what was happening was that credit was being made available very freely. And at the same time, people were borrowing on margin. Now, most people, if you invest in the stocks, one of the things that you notice that when you opened your account, that they offered you what is called a margin account. Margin allowing you to buy with borrowed money. So let's give an example. If you put $1,000 into your stock account, well, with margin, you will have $2,000 because they give you 1 times your leverage. All right? So $1,000 times 100% is another 1,000. So you now have $2,000 to work with. So that's a margin account. That's your basic margin account and so forth. So they did the same thing during the '20s, the Roaring '20s. And folks went ballistic. They were nuts. They were buying stocks left and right because everybody was in a state of what? Euphoria. We felt good. People were buying new cars, enjoying themselves. The only bad thing at that time was prohibition. You couldn't get yourself a good drink. At least not legally, of course. But that's a whole other ballgame. We'll talk about another, a little historical thing there, right? But needless to say, what had happened was that folks were buying stocks. And the market ran tremendously. Let's skip to the future. 2000, market crash. 2001, 2002, market recovery. Market starts to pick up from 2002, 2003 to 2006. Now, before Alan Greenspan retired, he spoke about something called irrational exuberance, right? And irrational exuberance means that people are just so giddy about investing and making money that they forget certain fundamental things, especially when they forget the understanding about cycles and so forth. So 1920, 21, 22, the banks start falling apart, banks start closing, and the market is in a turmoil. So what happens? Well, they institute certain measures, they support some of the banks, and they close some of the banks and so forth. From 21 to 29, Herbert Hoover eventually became the president, also instituted some measures in relationship to saving the banks in Wall Street. But eventually, what happened around 29 was the market crashed. It tanked. And if we look back at 06, 07, the warning signs were there, but we didn't see it. And most of us were not taught what to look for. You see, in any investment market, there are 4 basic cycles. There's 1, the bottom of the market, right? That's where we saw when the market crashed in 2001. We went straight to the bottom. The NASDAQ fell, lost about 40% of its value. The Dow fell, lost another 30% of its value in a very short period of time, over a matter of about 3 or 4 weeks. But then, after the down part, we have the next part of the cycle, which is the recovery. Can everybody say that with me? Recovery. Recovery. So we're now recovering, right? It's like somebody getting over a hangover and so forth. The eyes are a little bit clearer. They're no longer glassy-eyed, and they're starting to see things a little better. So we started seeing a better picture of the economy. We started making better sense, and a lot of us started feeling a lot better that we can now invest some money in the economy. So they also started stimulating the economy by giving access to free money through